Welcome. Today we're going to be talking about Bollinger Bands. Bollinger Bands are an indicator used to show a potentially overbought or oversold condition for particular security. When the prices are near the top of the band, that indicates an overbought position. When they're near the bottom, that indicates an oversold position. When the bands are close, that's a period of lower volatility. And when they're wide, there's wide spacing, that's a period of higher volatility. What this is based on is a 20-day moving average, which is the dark orange line in the center of the bands. And two other trend lines are plotted. These two trend lines are two standard deviations away from the 20-day moving average. And so what is that? Standard deviation, in very simple terms, is the difference between that average and the different prices. So if the price is 5 and the average is 5 and the price closes at 10, your variance there would be 5. If the average is 5 and the price closes at 4, your variance would be -1. And there's a much more complicated mathematical equation with square roots and stuff like that that goes into it. The reason it's used is because on a normal distribution, when it's the bell curve, two standard deviations is going to contain 95% of the values. So two standard deviations from that mean, from the average, is 95% of the values. What that means for us is 95% of the price action is going to be between those two bands. And you can see that. Here we have Diamondback Energy, and here's a case where it closed outside the bands, and then we're inside the bands, closes outside there. And you can see that the vast majority of the price action, which is the blue line, is within those bands. And there's occasions when it pops out. That's statistically your 5%. And so what is that? Again, when you have higher variance, right? When your prices are farther away from that average, that's a period of higher volatility. And when they're closer to the average, that's lower volatility. Closer to the average means you're going to have narrow bands. Farther from the average is going to be the wider bands. And so what this is based on is that it's based on that 20-day moving average, and you can change that, but that's the standard case. It's based on the principle that this price action is going to revert to the mean. It's going to come back to that moving average. And you can see that it does pretty closely follow it. Obviously there's spikes up and down, but it does come back. And that principle is used when employing this indicator. You'll see that when the price touches or breaks through the top band, here we can see it again coming back towards the mean and then breaking through it, right? And likewise here, where it crosses through and it touches the bottom band, it reverses course, and then it breaks through the average and then goes to the top band. And then it hits the top band, it exceeds it a couple times, and it comes right back down. So that's one of the central principles here, is price reverting to the mean. The other one is the squeeze, and the squeeze is these periods of lower volatility. What it can be is an indicator that the price action is going to change. It's not a predictor of the price action changing. It is an indicator that it might change. So we can see here that you have a period of higher volatility. It's trending down. You can see the slope going down, and then there's a squeeze here, right? And what happens is the price action reverses and it starts going up. But that's not always the case. Again, these are indicators of activity. These aren't trading signals. So you're not always going to act when one of these events occurs. We have another squeeze here. Price has been trending up. There's a squeeze, that period of lower volatility. And what happens? Well, the price continues to go up. So this is not an indicator that should be used on its own. You use this in conjunction with other tools. You're going to use market news, research. You're going to follow other trends in the stock. Again, you're not just going to use the bands and where it is. You're going to follow the trend. It's on an upward trend here. You can see the upward slope. And that's what you'll use. You won't just use the fact that it broke through the band. You might employ a parabolic SAR, other indicators that we're going to learn from the group. But again, do not use this in a vacuum. Hope this has been useful for y'all, and let me know your feedback. Thank you.